everyone. Welcome to this latest edition of Markets Monthly Strategies and Perspective, November 2024. My name is Gary Quinzel. I'm the Vice President of Portfolio Consulting here at Wealth Enhancement. And as always, I'm joined by Yoshioka, one of our senior portfolio managers and our senior equity strategist. If we could jump to the next slide. I want to start us off, as always, by sharing some perspectives and insights from our roundtable. It's been certainly an exciting couple of months, really, for the markets, as we've been on quite a roll. We've seen a lot of positive momentum for the market. However, October leading up to the elections, we saw the first down month in quite a while. And so what happened was stocks retreated. They took a little pause ahead of the election. There was a lot of uncertainty for a few weeks there, uncertain about what the outcome was going to be, uncertain about what the Fed was going to do at their meeting in November, which of course has already passed. But of course, now we know the results. And so whatever your position, the way you feel about the outcome of the elections, is one thing that as investors we can feel good about, is that we now have certainty about who is going to be running the White House, Congress, and Senate. That is helping drive clarity. That's one of the reasons why we're seeing some more positive momentum. The markets have picked up where they left off prior to October, and they have once again been performing quite well. And we're having an incredibly strong year for the markets for a variety of reasons, for fundamental reasons, because we are now in a period where the market is expecting lower interest rates. The job market, it's been definitely a little softer than it has been, but it's still relatively strong, and GDP has been solid as well. We're going to talk a little bit more about all these factors in a couple slides. The one thing that really continues to hang over all of this is deficit spending, and the fact that we knew going into the election, no matter who won, the outlook for our deficit certainly was not very positive. The expectations are that we are going to continue to rack up more debt. That certainly has weighed heavily on bonds, and we're seeing that come out in the yields of U.S. Treasuries, and we're seeing that tick up. We're going to talk a little bit more about that as well. But it's great to know that the election is behind us. More importantly, those political ads are behind us. We don't have to see them for a couple more years. I'm so excited about that. And we can turn our attention to things that matter more, the fundamentals, corporate earnings, and focus a little bit more on policy shifts and things that are actually going to directly impact the markets in our lives on a go-forward basis. So with that, let's go ahead and dive right in. Let's take a look at performance for the month of October. Aya, take it away.
Thanks, Gary. Thanks for that great intro. And when we look at the month of October, yes, we had a pullback in markets, both in equities as well as fixed income, and even on the commodity side. You can see on the column, the month-to-date column, that the only positive area was the U.S. short Treasury section, but everything else was red. And this comes after U.S. equity markets having a lot of strength throughout the year. And once the election and the Fed meeting were over, we've had some really strong market movements, especially in the U.S. U.S. markets continue to march higher. I think the S&P 500 has had 50 all-time highs so far this year. So really great strength coming out of U.S. equity markets. Sort of the November update so far for international markets hasn't been as great. I think the international markets have softened a little bit sort of following the election. And as Gary mentioned, we've seen overall Treasury yields sort of back up both in September and in October. And that's kind of continued sort of post-election in November. So one of the charts that I thought was really interesting was this chart from Goldman Sachs, in which it shows the equity market reactions sort of on the day after the election. And you can see this year we've had one of the most robust sort of returns in equity markets in the last 40 years. And you saw on the day after the election, the S&P 500 was up over 2.5%, and the Russell 2000, or U.S. small caps, were up almost 6% on the day. So very strong returns out of the equity markets. In terms of the Treasury yields, we did see this backup in yields continue in September and October and into November. And one of the interesting things that we saw, I think, in markets is that, once the Fed was more certain. I think that the market was more certain that the Fed was going to be cutting rates. And once they started on this rate cutting path, the 10-year yield has actually the yield is more than the 2-year yield now. And you can see that in this chart where the red line for many months was below the green line. So the red line's the 10-year, the green line is the 2-year. And now as the Fed starts to cut rates, we're actually starting to see a normalization of the yield curve and a little bit of a steeper yield curve on the Treasury side. And with that, I will hand it back to you, Gary, for some economic highlights.
Thanks, Aya. Let's go ahead and dig in some of the economic highlights. So one of the things that we've talked a lot about in the past is the labor market, which of course has been slowing somewhat, but the October payrolls number really took a lot of people by surprise. If you look at that chart on the left, you can see that in October, we only added around 12,000 jobs, which is the lowest number since August of 2020. Now, while that does kind of stand out amongst the other months, it's important to understand why exactly that happened. So if we look at the right-hand side, we can actually see that the announced job cuts actually ticked lower the last couple of months, which is definitely a good thing. On the other side, not showing on this chart, is that permanent job losses actually have ticked higher a little bit. But if we really want to dig in to understand why we only saw 12,000 jobs created in October, really has a lot more to do about the noise that we experienced. And if we think back, there was multiple strikes going on. There was the Boeing strike, there was the port worker strike, both of which caused some disruption. And then, of course, we had multiple hurricanes. We had Milton, we had Helene, both of which displaced workers and disrupted economic activity. So I think it's really more of a one-off, and it'll be interesting to see where we go going forward. Our overall synopsis is that we continue to believe the labor market is in fact softening. There's certainly enough data out there to support that, but we just still do not see any evidence at this time that the labor market is falling off the cliff. And of course, this is something that Fed Chief Powell is going to continue to take a very, very close look at. If we shift gears and start looking at how the service economy is doing overall, this paints a much better picture. So what we can see from this line, that orange line demonstrates the ISM Services PMI, Purchasing Managers Index. And the way to read it is that if it's above that dark green line, it means the overall service economy is in fact expanding. And we can see that it's actually expanding at a faster rate. And that's due to the overall health of the economy. The fundamentals remain strong, people remain employed. And because we are a service-based economy, this is actually arguably more important than the PMI for manufacturing, which often gets a lot more of the financial press. So we view this as yet another positive that just helps demonstrate that the underlying fundamentals, and this is a very current indicator because surveying as of last month, that the underlying fundamentals continue to be relatively strong. Another thing that we really like to spend a lot of time on is how is the retail, how is the consumer doing and what impact does it have to overall GDP numbers? And we know that GDP has continued to be strong. We've seen another quarter of positive GDP. Expectations for the fourth quarter remain positive. And if we look at this chart right here, we can see what the contribution of personal expenditures has been to GDP. It's been 2.5% as of September, and it's really been steady going all the way back to December, really going all the way back the last several years. We've seen a steady contribution. That's because retail spending has remained very strong. In fact, we saw just in the October number that retail sales were up better than forecast, 0.4% month over month, relative to expectations for that were 0.3%. And it's really been widespread. Now, we are seeing some downtick on some of those big ticket items, things like furnitures and cars and stuff like that, but we are seeing overall health. And consumers are still spending, especially high income earners, and it's really just been helping push the economy along. And so we expect that to continue for the immediate future. With that, I'm going to pass it back over to Aya, who's going to provide some more perspectives for us. Aya?
Thanks, Gary. So as Gary mentioned, we've had really resilient GDP growth. And, we've seen the most recent third quarter estimate at 2.8% overall. And I think, one of the things that when we think about what is going on in the economy and with markets, one of the interesting things is that when we look back at GDP, the Fed actually began hiking rates when GDP was negative. And that's usually not the case. Usually the Fed is lowering rates in order to try to stimulate the economy again. And this time around, the Fed is actually cutting rates during a relatively strong economy. So we're seeing strength in GDP. It's been, elevated close to this 2.5% level over the last couple of years, and it's come down from this sort of really hot COVID years that we saw in 2021. But we're seeing some resilience, and this is a lot stronger than what we saw sort of after the global financial crisis. But we'll have to see the pace of Fed cuts going forward into 2025, and whether or not the continued strength of the economy slows down the pace of future Fed cuts. And another thing that I think everybody's looking at is just corporate profits. So we just ended third quarter earnings season for US equity markets. And, most companies reported relatively strong earnings. And this is more of a sort of overall corporate profits. And this measure is an economic measure that takes inventory and sort of depreciation into consideration. So it's a little bit more cash focused profits here. And you can see that corporate profits at 13% of GDP continues to remain really strong. So if not like at the highest levels, it's sort of near the highest levels that we've seen in decades. And corporations remain strong, which is really great to see, because that means potentially that, job cuts are not on the table as much as they would be if profit margins were a lot thinner. And then, the other thing in terms of inflation, so kind of completing this whole Goldilocks scenario where GDP is strong but not too hot, inflation's coming down but perhaps not cold enough for investors and economists. We'd like to see this continue to make progress towards the Fed's 2% goal, but we're starting to see some stabilization right around like 2.5 to 2.8%. It's a lot higher than what I think we'd all like it to be. So we'd like to see that continue to come down. But again, the economy remains so resilient that it might be tougher to get to that last leg towards that final 2%. So we'll have to keep watching that, and we'll have to see whether or not any of the fiscal policies that get put in place either next year or in 2026 start to reflate the economy, whether it's some of the tax policies or potential new tariffs that get put in place. All of these things might impact the overall economy and whether or not inflation might start to come back up again. With that, Gary, I'm going to turn it back to you for closing remarks.
Thanks, Aya. So let's wrap it up here with some outlook and opportunities. And I think it all, once again, comes down to the Fed, right? We talked so much about this. The Fed is looking to recalibrate interest rates to a new normal level, whatever that normal level might be. We, of course, had that 0.5 point cut back in September, another 25 basis point cut in November. Where do we go next, right? And so right now, expectations were for another quarter cut in December, but Chief Powell actually made some comments just recently that maybe cast a little bit down. Maybe we won't actually see another cut, and the Fed is going to continue to be very data dependent. But the overall expectation is that rates will continue lower. We haven't seen any evidence to counter that. It's just a matter of how much and how fast. And so in the meantime, I think the market can live with that, right? As long as that expectation doesn't shift to the opposite scenario. From a corporation standpoint, as I had mentioned, we just finished corporate earnings season, or we're coming towards the end of it, I should say. Overall, relatively strong. Maybe a couple measures were a tick below the averages that some would like to see, but I think we once again are demonstrating the underlying core fundamental strength of the overall U.S. economy. And as I talked about at the top of the call, the U.S. election is finally behind us. We have better clarity. It's going to continue to crystallize in the coming weeks and months and get a better understanding of what this all means. And we're going to be addressing that in a series of updates as we get even more clarity from the White House and from the government, and we better understand what's going to happen with the Tax Cut and Jobs Act, what's going to happen with potential tariffs or deportation policies. There's a lot of things on the table. A lot of things are controversial, but at least we have better clarity so that we can incorporate that into our thinking on a go-forward basis. From an opportunity standpoint, we still believe that there's a lot of opportunities across all equities, not just U.S. large caps, although they do continue to demonstrate strength for the alternative, artificial intelligence tailwind that we've been talking about a lot. It continues to run strong. There's a lot of reasons to like U.S. equities, but there's also a lot of reasons to look beyond U.S. large cap to basically balance your overall risk exposure for multiple reasons, valuation being one of them, but just also looking at better opportunities. And if you think about, one of the things that could really benefit, smaller businesses, for one is this expectation of a more friendly regulation environment that could impact, equities beyond large caps. So it's something we're going to focus a lot on a go-forward basis. From a fixed income standpoint, we talked about the backup in yield, based on expectations for, we still have higher growth expectations. We also have the deficit situation, and there are still some thoughts that maybe inflation could tick higher because of the tariffs. And we're not going to plan on that at this point, but we are seeing the yields actually go from around 3.6 to around 4.4 on the 10-year. So, this is an opportunity, right, to lock in higher yields. As you see yields go higher, that's when you want to actually lock them up. And we have been thinking a lot about moving more towards the belly of the yield curve, where it's a little bit steeper and where we can lock in those higher yields for a longer period of time. There are some good opportunities there. And just general practice, we always believe if you use volatility to your advantage, take advantage of it by rebalancing and harvesting losses, especially as we're here at the end of the year. There's a lot of good opportunities for that. And always, if there's always opportunities to incorporate assets in your portfolio that can help buffer against volatility. And if you want to learn more about those, please reach out to your financial advisor. So that's all for this month. Thank you, as always, for joining us. We hope you all have a great day and a great month. And please join us in December. Thank you.
Thank you.